Hey everyone, welcome to the channel. Have you ever looked at a company's financial report and thought, what do these numbers mean? Is this company actually profitable? If you've ever thought about investing in stocks, running a business, or just want to understand how a company makes money, you need to know how to read a financial statement. In this video, I break down 3 key financial statements every investor should know: balance sheet, what the company owns and what it owes; profit and loss statement, how much profit a company made; cash flow statement, where does the money actually go. After watching this video, you will be able to analyze key financial indicators and make smarter investment decisions. So don't forget to like, subscribe, and comment below with any questions. Let's get started. Understanding a company's financial health is like checking its medical records. These 3 financial statements give us a complete picture. 1. The balance sheet, a company's financial position. The balance sheet shows what a company owns, assets, what it owes, liabilities, and its net worth. Equity: assets, cash, inventory, equipment; real estate: liabilities, loans, accounts payable, outstanding debt. Equity: the company's actual worth after subtracting liabilities from assets. Example: imagine you have $50,000 in savings and own a house worth $300,000, but you still owe the bank $100,000 on your mortgage. Your net worth, equity, is $250,000. For companies, it's the same concept. A high debt-to-equity ratio means the company relies too much on borrowed money, which can be risky. 2. The income statement, how profitable a company is. The income statement, also called the profit and loss statement, shows how much revenue, expenses, and profit a company has over a specific period. Key elements: revenue, sales, total income from selling products or services; operating profit, revenue minus the cost of doing business; net profit, the final profit after all taxes and expenses are deducted. Example: suppose you run a coffee shop. You make $10,000 per month in sales. After paying for rent, coffee beans, and staff salaries, your expenses are $7,000, leaving you with a $3,000 profit. A company's profit margin tells us how efficiently it converts sales into actual profit. 3. The cash flow statement, where the money goes. Cash flow is crucial because even a profitable company can go bankrupt if it doesn't have enough cash to pay its bills. There are 3 types of cash flow: operating cash flow, cash from the company's main business activities; investing cash flow, money spent on buying assets or making investments; financing cash flow, money raised from loans or investors. Example: in 2019, Tesla was still reporting losses, but its operating cash flow was positive, meaning the company had enough cash to continue running its business. A company with negative cash flow over multiple years might be in trouble, even if it's reporting high profits. Now that you understand financial statements, let's look at some key financial ratios that investors use to evaluate companies. 1. Debt-to-equity ratio measures financial stability. Formula: total debt, total equity. 2. Operating profit margin measures business efficiency. Formula: operating profit revenue 20% or higher. High profitability, for example, Apple, Microsoft, 10% or lower. Low profitability, for example, retail or airline industries. Example: why is McDonald's more profitable than your local burger shop? McDonald's has strong brand power, cost efficiency, and scale, leading to high profit margins. 3. Price to earnings, P/E ratio, measures stock valuation. Formula: stock price earnings per share. High P/E, above 30, investors expect high future growth. Low P/E, below 10, the stock may be undervalued. Example: in 2020, Tesla's P/E ratio was over 1,000, meaning investors believed in its future growth, despite its small profits at the time. Now that you know how to read financial statements, here are 3 key tips for making smart investment decisions. Look for financially stable companies. Low debt and strong cash flow are signs of a healthy business. Compare companies in the same industry. A 5% profit margin Might be great for supermarkets but terrible for tech companies. Think long term. Don't just look at last year's numbers. Analyze trends over 5-10 years to see how a company is growing. Today, we covered the 3 main financial statements: balance sheet, income statement, cash flow statement. Key financial ratios to evaluate companies. How to use these reports for smarter investing. If you found this video helpful, hit the like button, subscribe, and turn on notifications so you don't miss future finance tips. Thanks for watching, and I'll see you in the next video.